Hello, welcome. In this video, I will introduce relevant costs. Introduction. Relevant costs are future incremental cash flows that arise as a direct result of a management decision. When making short-term decisions, only relevant costs should be considered. A cost is relevant only if it satisfies all these three conditions. 1. Future. It is a cost that will be incurred sometime in the future. 2. Incremental. That cost is affected by the decision. Either it increases or decreases as a result of the decision. 3. Cash flow. It involves actual movement of cash. Either it is a cash inflow or a cash outflow. Cost behavior classifications. Understanding how costs behave is the foundation for identifying relevant costs. 1. Fixed cost. This cost does not change with the level of output within the relevant range. Fixed costs are irrelevant unless the decision causes it to change. 2. Variable cost. This cost changes in direct proportion to output. Variable costs are relevant since every extra unit produced changes the total variable cost. 3. Semi-variable cost. This cost has a fixed component and a variable component. Only the variable portion is typically relevant to a marginal decision. 4. Stepped fixed cost. This cost remains constant within a specific range but jumps to a higher or lower level at certain activity levels. The incremental step-up amount becomes relevant if the decision triggers it. Types of relevant costs. 1. Opportunity cost. The opportunity cost is a benefit foregone by choosing one alternative over another. It is always a relevant cost, even though it never appears in the accounting records. Example, a machine can make product A to earn a contribution of $20,000 or product B to earn a contribution of $15,000. If product A is chosen, the opportunity cost is $15,000, which is the benefit foregone. 2. Avoidable costs. Avoidable costs are expenses that can be eliminated by choosing not to engage in a specific activity or by discontinuing it. Example, if a company stops making a product, it will not incur the cost of the materials that were used to manufacture the product. 3. Incremental costs. These are additional costs that are incurred if a decision is taken. Example, a new storage unit is rented at $500 per month purely to fulfill a special order. The $500 is an incremental fixed cost and therefore relevant. Irrelevant costs. Irrelevant costs are past costs or future costs that are not affected by the decision. They remain unchanged regardless of the decision made. Types of irrelevant costs. 1. Sunk costs. These are costs that have already been incurred and cannot be recovered regardless of the decision made. They are irrelevant. Example, market research was done last year to evaluate a product launch. The market research cost was $20,000. The $20,000 is a sunk cost. It cannot be recovered whether the product is launched or not. 2. Committed costs. These are future costs that will be incurred regardless of the decision. They are unavoidable and therefore irrelevant. Example, a lease was signed last year that legally obligates the company to pay $10,000 per year for the next 3 years. The $10,000 is a committed cost since it will be incurred regardless of whether the project or contract proceeds. 3. Notional costs. Notional costs are expenses that do not involve any actual cash movement and are therefore irrelevant. Examples of notional costs are depreciation, notional or imputed rent, and general apportioned overheads. Relevant cost of materials. The relevant cost of materials depends on the situation. In situation 1, the materials are not in stock. In this case, the relevant cost is the current purchase cost, since the materials will be purchased specifically for that decision. In situation 2, the materials are in stock and are regularly used. In this case, the relevant cost is the current purchase cost, since materials will be purchased to replace the stock used for that decision. In situation 3, the materials are in stock but not regularly used and have a resale value. In this case, if the materials are used for that decision, the relevant cost is the net realizable value, which is the opportunity cost of not selling the materials. In situation 4, the materials are in stock but have no other use and have no scrap value. In this case, the relevant cost for the materials will be 0. Example, there are 200 kilograms of material in stock, but the material is not regularly used. The material costs $4 per kilogram, but could be sold for $3 per kilogram. What is the relevant cost of the material? Answer: $4 per kilogram is a past cost, hence irrelevant. The relevant cost is the resale value, $3 per kilogram, which is the amount lost by not selling the material. The relevant cost for the 200 kilograms is $600. Relevant cost of labor. The relevant cost of labor depends on the situation. In situation 1, there is spare capacity and the staff is paid regardless of the spare capacity. In this case, additional work can be undertaken at no additional cost, hence the relevant cost is 0. In situation 2, labor is working at full capacity and will be diverted from other work. If the labor is used for a special order, project, or contract, the relevant cost is the variable cost plus the contribution lost from diverted work. In situation 3, labor is working at full capacity and cannot be diverted from other work. In this case, the existing labor may work overtime or new workers will be hired, hence the relevant cost is the total overtime cost or total current paid for the new workers, respectively. If labor is working at full capacity and different options are given, analyze each of them and choose the cheapest option. Example, a contract requires 150 hours of skilled labor. The wage rate is $12 per hour. The existing salaried workers have spare capacity. What is the relevant cost of labor? Answer: the existing salaried workers have spare capacity. Workers are on a salary and currently have 150 hours of time available. The cash outflow will not change due to the contract. Wages are paid regardless of whether the contract is undertaken or not. The relevant cost is $0. Deprival value of a machine. The deprival value is the loss a business would suffer if it did not have the asset. It is the lower of the replacement cost and the recoverable amount, where the recoverable amount is the higher of the net realizable value and economic value. The economic value is the present value of the future cash flows that the asset will generate. The first step is to identify the three values, that is the replacement cost, net realizable value, and economic value in business. The second step is to find the recoverable amount, which is the higher of the net realizable value and economic value in business. The third step is to compare the replacement cost and recoverable amount to determine the deprival value. The deprival value is the lower of the two. Example, a machine has a replacement cost of $80,000. Its net realizable value is $50,000. It has an economic value of $70,000. What is the deprival value of the machine? Answer. The recoverable amount is the higher of the net realizable value, $50,000, and the economic value, $70,000, which is $70,000. The deprival value is the lower of the replacement cost, $80,000, and the recoverable amount, $70,000, which is $70,000. Therefore, the deprival value of the machine is $70,000. This is a short quiz with 3 multiple choice questions. You will have 1 minute to read the whole question and select the answer that you think is correct. Then I will reveal the correct answer. Good luck. The correct answer is B. The $45,000 was spent last year. It is a past irrecoverable cost. Whether the company launches the product or abandons it, that $45,000 cannot be recovered. Sunk costs do not satisfy the futuristic condition for a relevant cost and should be excluded. The only relevant figure here is the future investment of $120,000. The correct answer is C. The relevant cost is the opportunity cost, which is the net realizable value of $25,000 that is foregone by using the machine on the contract instead of selling it. The original cost of the machine, $80,000, is a sunk cost, hence irrelevant. The annual depreciation charge of $10,000 is a notional cost, which again is irrelevant. What the company will actually lose is the $25,000 when they don't sell the machine. The correct answer is D. The lease cost of $60,000 is a committed cost. It will be paid regardless of the decision made. Therefore, it is irrelevant. However, the ability to sublet for $40,000 represents an opportunity cost. By using the warehouse for the project, the company forgoes $40,000 of rental income. Therefore, the opportunity cost of $40,000 is the relevant cost.